Today, the Reserve Bank of Australia decided to sit tight and hold off from cutting rates further. But with the domestic situation having not weakened, employment remaining fairly strong, and indeed increased export volumes offsetting weaker commodity prices, the market consensus was for rates to remain on hold in July. Joining me now to discuss this alongside other matters is Richard Grace, Chief FX Strategist and Head of International Economics at the Commonwealth Bank of Australia. Richard, is it fair to say this was already priced into the markets quite far in advance?
Yes, to a large extent. I don't think there was any large expectation that the RBA would cut rates today. The general consensus, certainly from economic surveys and from market participants we spoke to, was that no one really anticipated that the RBA would cut interest rates. And if you observe the movements in the Australian dollar and the movements in the Australian bond market since the RBA's decision, then it's fair to say that the limited market reaction is pretty consistent with the fact that no one expected them to change rates today.
Let's not forget that it takes a few months at least to feel the effects of a rate cut, and the RBA has cut the cash rate 4 times in the past 8 months. Is it also fair to say that the RBA has perhaps bought itself some time now to assess the conditions and also the effects of these cuts and assess the outlook for Europe and Asia?
Yes, certainly. I mean, in the RBA statement, they said that there has been a material easing in monetary policy over the past 6 months. And I took them to be quite firm words, indicating that they believe that they've probably done enough now in terms of easing monetary policy, reducing rates. And they've added some comments saying that maintaining low inflation over the longer term will require growth in domestic costs to slow, because the effects of the early exchange rate appreciation are waning. Again, it's just supporting our view that it appears that the RBA is quite comfortable where it's got monetary policy settings. At the moment, we have penciled in a cut for next month, but I think there's a fair chance we'll remove that. As you indicated, it does take some time for rates to be felt through the economy. That's a normal monetary policy transmission mechanism. And having heard what the RBA has indicated, that they see a material easing in policy over the last 6 months, there's a strong chance that they won't do anything for some time.
What about other factors like credit growth, the housing market and, for example, manufacturing and the mining sector?
Yeah, credit growth is very shallow at the moment. Business credit has recently picked up, but overall credit growth is running at very modest single-digit rates. We are not expecting a significant pickup in the economy led by credit conditions stimulating activity. But having said that, the domestic economy is currently growing very rapidly. In the March quarter, numbers indicated the economy grew 1.3% in real terms, and 4.3% from a year ago, with domestic demand growing at a rapid 1.8% in the quarter in real terms. So it's not as if the Australian economy is suffering as a result of very modest credit growth. But nevertheless, the RBA felt that given the offshore risks, they would move interest rates into more accommodative settings in order to stimulate growth should that need occur. The housing market is coming off very low base. It has picked up according to the recent monthly data, but construction remains very weak, certainly in some of the larger states of Australia. House prices have softened recently, but the recent reduction in interest rates would tend to support a view that house prices are unlikely to collapse, particularly with the unemployment rate in Australia so low. It would appear that the general health of the Australian economy, despite being much stronger in the mining sector as opposed to the non-mining sector, isn't doing too badly at all.
As we know, commodity prices are seen to be a major driving force behind fluctuations in the value of the Australian dollar. What is your short, mid and long-term outlook for the Aussie dollar?
In the short term, we think the Australian dollar will probably struggle to get above 104, the short term being the next month or two, and if it did, we would probably suggest to participants that they sold into rallies above 104. This is because we're anticipating further softness in Asian economic growth. We think the weakest point of the Chinese economic cycle is yet to be reached, but we should see it in the next month or two before we begin to see an acceleration. The other reason is the economic contraction in Europe appears to be accelerating. The US is going through its mid-cycle slowdown, and that has gained some momentum as well, particularly considering the recent ISM survey, which dipped into contractionary territory below 50 for the first time in 3 years. So that would be our strategy over the next month or two. But following that, towards the end of the year, we would probably flip that on its head and be a buyer of Australian dollar on dips.
What about the effects and costs of this extremely controversial new carbon tax which came into effect on July the 1st? Where do you stand in regards to this tax, and how hard do you really expect businesses to be hit?
Yes, certainly there will be some pain. There has also been a compensation package rolled out at the same time to try and make the effect of the tax relatively neutral. The inflationary impacts of the tax will be somewhat notable, but the Reserve Bank of Australia said they will look through those inflationary impacts. But in terms of the expectation of a normal settling in process for participants exposed to the tax, if you sort of exclude that, I don't think that the tax will be detrimental to the overall growth rates of the Australian economy. I think the Australian economy is well positioned to absorb it at this stage. And as far as offshore observers are concerned, it really shouldn't make a great deal of difference. It shouldn't affect the value of the Australian dollar, for instance. And as I mentioned, it's revenue neutral, so it shouldn't upset the government's budget position either.
Richard, I'm afraid that's all we've got time for, but thank you very much for speaking to Dukascopy TV about your outlook for the Australian economy in the second half of the year. We've got plenty coming up on Dukascopy TV today and all the usual Forex updates and news, so make sure you stay tuned. But for now, goodbye.